When does diversification lower risk and when does it increase risk? So I'll give you an example of when it increases risk, right? Let's say you have 10% in Bitcoin, 10% in silver, 10% in bonds, 10% in corporate bonds and 10% in government bonds, and the rest is in markets. I would say that's a much more risky strategy than having 90% in markets and 10% in bonds, because some of those assets like Bitcoin are pretty much based on speculation, and some like silver, and for that matter gold, tend to just be not only very volatile, but they tend to actually not increase over time. Like the price of gold is the same as it was during the time of Christ. So the point is, as Warren Buffett said, over diversification is usually used by somebody who doesn't know what they're doing. However, bonds and indeed real estate investment trusts can actually lower risk in terms of bonds don't produce what stocks produce. However, they're like parachutes when stocks are going down. I'll give you an example, 2000 to 2010. US stocks and indeed international stocks were pretty much stagnant or even slightly down for those 10 years, but bonds went up. There's been other periods where stocks have been down and bonds have gone up. So adding 10% bonds when you're young and increasing that to 40% when you're retired definitely lowers risks. Likewise, having just 10% in real estate investment trusts lowers risk as well for the same reason. It's not 100% correlated to markets. Now, don't get me wrong, usually when stocks go up, REITs can go up and vice versa when they're going down. However, various academic studies have shown by adding 10% real estate investment trusts, it slightly lowers the volatility, but also slightly increases returns. Only slightly. I was reading a study showing that it only resulted in about a 0.2% extra yearly return. But the reason why they gave a slightly higher return than having no REITs is because essentially the real estate investment trust, they perform badly when stocks perform well and vice versa, or slightly less badly, or slightly, they slightly overperform. So if you see what I mean, you've got stocks, you've got bonds, and you've got real estate investment trusts. And even though some of these assets can be correlated to a certain extent, some of the assets perform well when other assets perform badly. So if you have a buy, hold, and rebalance strategy, this kind of diversification can lower risk. In comparison, if you just buy like 10 or 20 different investments, including things like Bitcoin and cash and gold, that is not sensible, and that actually doesn't reduce risk. Put it this way, investing in the Zimbabwean dollar, I don't think anybody would say that that reduces risk, even though it's adding diversification. Okay, everyone, have a good day.